So apparently mortgage rates have dropped their highest amount in over 40 years. That's right. Over the last few days, I've seen article after article after article telling us that mortgage rates have dropped over half a percentage point for the first time since 1981. The average rate for a 30-year fixed mortgage was 7.08%. And now this week, the average rate is 6.61%. Seems pretty good, right? The problem is, most of those articles were kind of just fluff pieces. I can't really say what the agenda is to really push these articles from the point of view that they've been written, but all of the articles I've read, aside from Bloomberg, seem to act like it's a thumbs up for everybody to go buy houses. The truth is, the data as given does show a rate drop. But it's also the truth that Freddie Mac changed the way they calculate the average interest rate. So it's almost like you're comparing apples and oranges. Still, the rate did drop. I just don't think you can accurately compare it to last week's rate, let alone 1981's rate. Given that, people are excited that the rates have dropped. And yeah, it does provide a little tiny bit of relief, but only a tiny bit. The thing is, we don't know how long it's going to last for, and it's probably not going to last. One of the big reasons the rates dropped recently was because of the CPI report data and a statement made by the Federal Reserve. The Federal Reserve has announced that inflation is starting to go down. That's important. It's starting to. This got the markets really excited that the economy was going to start doing better again, and that reflected in lower bond rates. And as I've mentioned in previous videos, when the 10-year Treasury bond gets lower, there's usually a direct effect on mortgage interest rates. So when the 10-year Treasury rate dropped below 4%, mortgage rates dropped. Since all these positive media articles came out about lower interest rates, the 10-year Treasury rate has actually climbed up a little bit again. It's not as high as it was, but it is climbed a bit higher. And that makes sense. The Federal Reserve doesn't want to see that surge in the economy yet. They still want to slow the economy down. That means that they want to keep bond rates higher and they want to keep other investments lower. They still intend to raise the Fed rate over time, which means that for the time being, we are probably still stuck at high interest rates. I really view this 0.5% drop as like a knee-jerk reaction to positive news. I think that once that all calms down, reality is going to set in again, and we're going to be back on the path that the Federal Reserve wants us to stay on. Because if we get too excited too fast and have a surging economy too fast, then inflation continues. And if you don't understand anything that I've just said, I'm just really trying to get across the message that interest rates dropped, they're probably going to go up again, and they're probably going to stay high overall for a while until the Federal Reserve gets their job done. So I know this was kind of a short little video today. I just wanted to clarify something that I was seeing because I felt like there was only half truths being told by the media. What's new, right? So if you're looking to get into the real estate market, I wouldn't worry too much. I think mortgage rates are going to come down in time when the Federal Reserve eases on the economy. But until then, just keep saving for your down payment and keep learning about the process. And if you learned anything new today here, don't forget to like and subscribe. As always, I will see you next time.